Good afternoon, ladies and gentlemen, and welcome to the ZIGUP PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it is appropriate to do so. Before we begin, as usual, we would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Head of Investor Relations, Ross Hawley. Ross, good afternoon, sir.
Hi, Jake, and thank you very much for that intro, and welcome to everybody online today. This is our fourth IMC session, which we've run, and this one comes after our half-year results, which we announced last Wednesday. So we're currently on roadshow talking to various institutional investors. The format for these, which has worked well, is really a fireside chat format, where I will look to weave in questions, which hopefully you'll be putting onto the Q&A tab throughout. So do please put those in, and I'll remind people every so often. But I think before that, probably best if I ask Martin and then Philip to give some overviews of our first half performance from an operational and a financial perspective. So with that, let me hand over to Martin, CEO, to give some introductory thoughts.
Thank you, Ross, and good afternoon, everybody. I'm just going to cover the first three slides before handing over to Philip. So if we just look at slide 1 first, and just take a look at the H1 performance during the period. So good performance across the board. We're delivering on the strategy. These results are in line with expectations, the market expectations. So what we've seen in the period is good operational momentum in terms of what we're doing across all of our business lines. And that's sort of combined with healthy demand and improving supply as well, in terms of sort of coming back to what I would see as more normalization post the pandemic. As we anticipated and signaled to the market, we saw disposal profits normalizing. It's a story of two parts with Spain and the UK and I, but I'll come and do a bit more on that shortly. We are investing in the business for further growth and strong returns, and we've got positive momentum as we exited this period into the second half, which we'll come on talking about as well. I just look at the financial performance and say Philip's going to give a deep dive, but just to pull out what I think is the summary here. As I said, good set of results, have a strong underlying business. You saw revenues up 5%, with the group on course to deliver the underlying PBT in line with the market expectations for the full year. And for those that haven't got access to that, market expectations are around 161 million PBT. We're at 82 million for the half year. As I said on that strategy, we see continued benefit of the integrated platform. Revenue growth came across all of our sectors, the UK and I, Spain, and our claims and services. In this period, I would call out Spain as being a standout performer. It's got a very strong economy. It is supporting the demand, and we're seeing a growing demand from a variety of customers across the piece. And if I look at van rental particularly, we've had our highest new business wins since 2019. So a very strong position in this period. And as I say, we're continuing to invest in our platform. And by that investment, I'm talking about not just investing in the fleet, I'm talking about investing in our tech stack and investing in our people. We saw strong cash generation as well, which has enabled us to continue that investment. Since point to point, we've grown the fleet over 4,000 vehicles. The fleet now stands at 132,500 vehicles. And of course, when we're buying fleet, we've got a CapEx outlay, but don't forget the value of that fleet goes on the balance sheet as well, which now stands at 1.4 billion of assets just on the fleet alone. And through that investment, we've seen the fleet age fall as well, down 2 months versus the prior period. So all of that's sort of been leading to some excellent shareholder returns. So obviously we closed off the share buyback, the third program of the share buyback in the period. So that's 90 million in total. We've supported dividends full year, and now another dividend at the half year of 8.8 pence. And we see that, as a sustainable, continued, progressive dividend based on the visibility we have of the cash returns. So to summarise on this page, I'd say strong balance sheet, growth in our underlying EBITDA. We've done all of that whilst also maintaining leverage at 1.6 times. And to be clear, that leverage has been 1.6 for the last 5 years. So although we've added to the value, we've added to the earnings, the leverage has been consistent. And if I look at the next slide, just to sort of have a little deeper dive with some of the businesses, so I'll turn to rental. We talk about fleet growth momentum. Simply, we have seen that continued demand as suppliers come back online, particularly in the UK and I. So we've got customers now taking on that new supply. Some of that is growth. Philip will cover the sort of growth aspects of that. And in Spain, where the economy is very, very strong, we have seen continual growth in that in our VOH on the fleet. New wins, I talked about having our highest new wins since 2019 on the rental side. That's reflecting not just that demand in the market, but also the integrated sort of services we're offering on our platform. It's not just about a commoditized piece of metal. There is a service wrap that goes with the products that we have, and that's what customers and prospects are attracted to. So we've got good momentum on continuing to grow that. Talked here about cross-sell as well. People ask us, what opportunities have you generated by having this sort of platform and the different businesses linked together? Well, just in this period, we talk about an additional 750 vehicle rentals that have come across from different businesses as a result of having that crossover. And we've been investing in our charged EV business. This is the business that is installing electrical vehicle charging points. We announced in the set of results, 2 significant contracts with Scottish Power and British Gas. And we expect to continue to invest in that business because clearly that's supporting the transition to electric vehicles as we move forward. And that's both on domestic and commercial customers. If I look at claims and services, yes, we grew our revenue. Margin outcomes are different. We've talked about sort of different mix of business in our claims and services. So where we're growing, for example, in our repair body shops. So there's plenty of opportunity to take on repair work. We have the capacity to do that both in our network and our extended independent network. So that will grow the top line, but it does have a different revenue mix. So that's why you will see in our results, the margin mix has changed. We've got a broadening support in terms of what we're doing across that platform. So it's not just about non-fault accidents, which is where the genesis of the business is. It is about providing more product and service, from roadside accident recovery, through courtesy car, through the body shop work, through the legal recovery, incident and fleet accident management as well. And we've been building on our digital services as well, adding in tech, where we can take some of the strain from a lot of heavy lifting work. So using digital to help with more self-service on our portals. And also, for those of you that recall, we talk about protocol. So protocol for insurers is where we have an agreement, bilateral effectively, with each insurer, where we have a set of rules that enable them to pay a claim very quickly without any friction. And it's an agreed, negotiated upfront settlement so that you don't have to go through a lengthy process to make a recovery. That aids our cash recovery and lowers our operational cost in collecting cash. I think we're up at nearly 70% now in the business, which is near a record high. And if I look at the third quadrant, they're focused on the customer delivery. In March this year, we brought our UK and I management team together as one. So we had what was the claims and services side, the Ready side, and the Northgate management team. They came together as one team. So we have sort of one joined up management structure now to deliver a simplified customer service across the business. We focused on the customer first. We think that's extremely important because it's customer feedback that drives business to our door. So when you look at our Trustpilot scores across our businesses, we are rated as excellent. And that compares to some of our competitors who are rated as poor. I wouldn't normally bring that out, but it is an important point that we invest in customer outcomes, and we're very focused on that delivery. As I said, our Spanish business has been growing demonstrably. A good set of results, as you see when we go for the deepen and dive. But we have been broadening our services in Spain as well, slightly different to what we provide in the UK, but it's a broader set of services than Spain has traditionally offered. So that's also extending the growth trajectory for Spain. And then finally there, just on the sort of the ongoing investment, we talked about opening new sites and locations. So in the UK, it's a further site that we opened in Dundee. That's a body shop site. Why is that important? Well, as we sort of transition from some of the locations that we operate on, we're able to find our sweet spot in terms of site size, capability in terms of workflow, productivity. It delivers efficiencies, the way that we can move vehicles through. It's a modern, well-equipped site, and this is typical of what we are setting up, we have in the past, and we're setting up as we go forward. It just makes us more efficient in terms of being able to deal with repair capacity and productivity. And in Spain, we opened 2 sites previously, and we've talked about this new site in Cadiz in this period. Again, it just opens up more service points, which customers polarize towards. When we talk about tooling, ADAS, sort of advanced driver assistance services, we roll that out across our body shops. It's just using the latest tools, repair technology, to make us as efficient as we can. So we're at the sort of leading edge of what is possible out in the market, and that attracts customers to what we do as well. We're investing in our people, so over 400 apprenticeships now in the business across the UK and Spain. So we've got the next generation of technicians to support what we do. So overall, quite a lot of things going on in the business. As I said, delivering on the strategy, and we're seeing that through the momentum as we exited the H1 period. Okay,
Fantastic, thank you. And I think, Philip, can you just put these results in that financial context, and then we'll start to tease out some of the particular issues.
Yeah, sure. Good afternoon, everyone. So at a top line, our revenue grew across all of our businesses, so up 5.6%. And then the EBIT and the profit before tax are really reflecting predominantly the normalisation of disposal profits, which we spoke about at the year end and over the last 18 months or so. So the results are exactly in line with what we expected. And as Martin said, if you look at our results half year on half year, we're generally around 50-50. So we're exactly in line with what the market's expecting for the full year. Now, importantly, our fleet net book value increased by 200 million, and our debt only went up by 27 million. As Martin also mentioned, our leverage is unmoved at 1.6 times. And then our dividend per share up 6%. That's reflecting our dividend policy, which is to pay out as an interim dividend 50% of the full year dividend. Now, if we go on and just have a look at the revenue, you can see this chart here bridges the revenue from last year to the current half year. The first block there represents the UK and I rental revenue. Now, UK and I has been cycling against a tough comparator from a vehicles on hire perspective, and we'll come and talk about that a little bit later on. So vehicle on hire actually went backwards 4.6%, but despite that, revenue grew at 1.7%. And we're able to grow that revenue, one, through sensible pricing through to the market, but also growth in ancillary products and services, bringing additional revenue. In Spain, a different picture. So we've had good supply for a long time in Spain now on new vehicles, and VOH has grown 7.4%. And rental revenue went up 8.6%. So alongside that VOH growth, we've had pricing as well as some additional products and services as well. Claims and services, Martin mentioned we had good revenue growth there, contributing 25.8 million. And that's a different mix from that which we've seen in the past, with a greater mix on accident and incident management rather than credit hire and credit repair. And that does impact margin, which we'll come and look to in a minute. And then the vehicle sales, a reduction of 48.8 million, is just reflecting the normalisation of disposal profits and the ongoing normalisation of residual values in the marketplace. So if we go on to the next slide, we can just look at, okay, what does that look like from a profit point of view? So you can see we're bridging from the prior year to the current year, and you can see there's disposal profits there in the lighter purple colour there. Now, if you go to the middle of the chart, first of all, you can see there's an 8.9 million reduction in disposal profits half on half. And that's split across both Spain and the UK, just representing the normalisation of those residual values. If you go to the left-hand side of the chart, you can see that the growth in Spain offset the reduction of VOH in the UK. So we had a rental volume growth of 2.7 million. The rental margin movements, which are still very strong in both the UK and I, so UK is at 15.7%, and Spain rental margin very strong at 19.3%. But then they came down a little bit year on year, and that reduced profits by 3.2 million. But also within there, you've got a 1 million headwind on foreign currency translation of the euro to sterling as well. And we did have a cyber incident at the beginning of the year, and we had a one-off trading impact there on our profits of 4.2 million, which is equivalent to about 70 basis points impact on the claims and services margin. Then in terms of the additional volume, that delivered us 1 million of additional profit. And again, as I mentioned, that's reflecting the mix effects, a higher mix on slightly lower margin accident and incident management versus credit hire, as we saw a quieter summer on the volume of incidents and accidents referred to us for credit hire. And you can see that in the mix effect there on the 5.5 million on margin. And then we had an additional 1 million from interest charges reflecting the higher level of debt throughout the year. But when you step back, directly in line with what we expected and predominantly reflecting the normalisation of disposal profits in the first half.
Fantastic, thank you. So look, that I think has been very helpful to just kind of set the scene. I won't say quite a shout out, but thank you, Julie and Chris and a couple of others. Straight off the blocks of questions, I will try and weave them in. But I thought we ought to start off and probably back Martin to you. So I think on the roadshow when we've been going around, I think people, if I'm thinking about the UK and I, actually some of the comments we've said about UK rental demand being the strongest for 5 years. Obviously, we just had a budget and perspectives on that. But really, where's this demand coming from? Is it structural trends from ownership to rental, or actually is it just there's people starting to look for more supply, which they've not been able to get for the past few years?
I think it's both of those, Ross, to be fair. So if you look first of all at that sort of structural piece, our evidence still points to that sort of usership over ownership. So that's the structural trend that we've talked about. And then if you sort of categorize that and sort of bring it to life with what we're seeing on the ground. So I think I might have mentioned at the full year, you've had businesses that have run fleets under ownership. Post the pandemic, they were unable to get supply to be able to replenish the fleet. And therefore they've held that fleet over for longer than they'd anticipated. Now it's come to a sort of a point where you have to sort of replenish all of the fleet. So if you imagine you're an FD in a small, medium sort of size business with a fleet of 50, 60 vehicles, that's a very large check to write to buy your own fleet. So there has been that sort of support as well in terms of what we're seeing where those customers want to come into an operational model. Don't forget, it's not just about buying a piece of metal. When we do what we do, it's all the services that go to support that to keep the customers mobile. From having the workshops to be able to fix things very quickly, keep the vehicle legal and roadworthy, to have a replacement vehicle when there's something that has gone wrong and you need to be back out on the road. And as I say, to provide all the services that support that in terms of accident and incident management. So we've seen that sort of growth coming from that structural side. And also we've been successful in winning new business. So if I look at that sort of that record that I set since 2019 for new business wins, it's coming from market share as well. So we're winning from some of our competitors that don't have that full service wrap. I talked about Trustpilot and that we're invested in those customer outcomes. It's important. And if you go to one of our rental branches, for example, you can go in, there's a Q code there in branch, and we get real lifetime feedback from the people visiting our premises to tell us about the services. So we're very honed in on making sure that we have a very good sort of outcome. So that's where we're seeing that demand. And of course, now suppliers come back. That's why I talk about momentum and that momentum for growth.
Yeah, and in some ways, if I switch geographies, we've sort of seen this kind of demand and supply dynamic working well together in Spain. Philip and I were down there in September. We took some investors and some analysts down, and it's been an amazing growth story when those two things work together on that. It's been a great story. More to come?
I think so. I mean, I open the KPI sheet every day. I mean, I've seen about 4 or 5 visits to Spain at different locations to see that sort of on the ground activity, which does fill you with energy in terms of when you see how much sort of is going on the shop floor there. But I think more to come. As I said, I open the KPI sheet every day on Spain, and it's just continually more on rent, more on rent. We put the handbrake on, don't forget. We put the handbrake on. I talked about this at the full year because, when the market's sort of very worried about debt leverage and all the rest of it, and I think we're 1.6 times. Our competitors trade at 3 and 3.5 times leverage, in a private setting, and some even more. So look, we put the handbrake on just to sort of say we work within the confines of our leverage ratios, etc. We have put more facilities on to provide more headroom as well to trade, and we've seen that demand is being filled. So as we look forward, if we're going to meet that demand, we've already indicated, we signalled that we would have further capex throughout sort of 2025, 26, as we expect to fill that. And let's not forget that this is a correlation, as in you spend your capex, you put the value on the balance sheet, and you get all the future earnings and cash flows that come out of that. So it's a business that when you're investing up, you've got all that future visibility on what you're generating that's supporting the dividend and supporting that sort of continued growth.
Yeah. I saw that Gary, since we're talking about Spain, just in terms of sort of some of the new facilities. So when we add a new facility, how do they, are they day one firing up? I mean, certainly in Spain, there's been design. When you've been looking at investment and Jorge says we'd like to open up somewhere, how do you think about that? What are they actually demonstrating in terms of the growth early on?
Yeah, so what they're showing is, so when we look at all of our footprint in Spain, we've got very good coverage. So what we look at is the concentration of where the customer mix and where we're underrepresented as well. And the model works really, really well. It's a bit like what I would say Northgate UK was sort of 15 years ago. You open up a new site, a new branch or a service point, and customers polarize around that sort of service point. So before we hit the ground running, our account development teams are aware of which companies and organizations we're underrepresented in, fit the quality profile for credit ratings, etc. And we're able to go start those discussions. So we do hit the ground quite quickly. So, and those on rents for that branch obviously grow, but we hit the ground running with already a sort of ready-made batch of on rents to service.
And it's the same offering, it's just basically rolling out that capacity.
It's the same offering that's doing very, very well in Spain. As I said, it's a good service wrap in terms of what we do. We see that, as I say, when we go out on the ground and see that customers in our branches and get that sort of feedback. So exactly that, and it's something that is in demand.
So on the rental still, demand side we've kind of touched in both areas and clearly strong and a lot more to come. And when one thinks about the supply side, you've sort of been messaging saying it's back to normal. There's obviously a couple of caveats around that, but just in terms of the vehicle availability and what we're seeing there, do you want to just cover that off?
Yeah, it is back to normal. Look, we only talked about availability because it wasn't availability post the pandemic. But going forward, it shouldn't really be a conversation, I guess, in the sense of you'd expect to be able to acquire your product, your fleet, etc. So as I said, there's only been a talking point post the pandemic because of those sort of constraints, particularly in the UK. And I think we were asked the question as well, so when supply all comes back and it's all normal, does that mean sort of pricing comes down? Does that mean demand comes off? Well, if you look at what Spain's had normal supply now for the last couple of years. We talked about that. Pricing has not come down. Demand has continued to go up. So it is about what we're doing specifically in the market. And in the UK, yeah, supply is normal. We'd expect to be having conversations now with manufacturers as we are around that sort of volume discounts that we would expect to be able to achieve from that. And also remember, we talk about margin. So we've said, margin 15% on the rental side, sustainable midterm. We said that when we get to the full year this year, we're going to look at that to see whether we need to revise it upwards because we're seeing Spain staying higher for longer. And obviously UK is over that as well. So we expect to see good returns and we can maintain our margin whether the input price goes up or the input price goes down, we've demonstrated that we're able to maintain that margin that we've been talking about.
And Christopher, I think you asked a question about margins. I think you asked UK and I. We'll touch on claims and services margins a little bit later. But Philip, just to bring you in, I think one of the slides which we had up, which we've looked at a number of times, really on this point, which Mark was saying about how supply constraint has been a challenge. And there's quite a good visual to see quite the difference between UK and I and Spain. Can you talk through that?
Yeah, look, I mean, so this slide here really showing our vehicles on hire for this year to date versus last year, because it's a different story both in UK and I and Spain, and that's really reflecting the evolution of vehicle supply, which Martin was talking about. I'll talk about the UK first of all on the left there. So last year we explained that actually VOH was shrinking point to point, and that was reflecting the availability of vehicles, which was more restricted in the UK last year, which meant as we were defleeting our office vehicles, we weren't able to replace them as quickly as we wanted to, and therefore the average of vehicles on hire inevitably decreased slightly. We used that to our advantage, making sure we were servicing the customers that were of highest quality and highest margin for us as well at the same time. So it means that this year, we started the year 3,000 vehicles behind where last year opened. So on H1 to H1 point of view, you can see actually we've been tracking below, but you can see the trend now as that access to vehicles has improved almost back to normal from a volume perspective in the UK now. We're now catching up, and actually by the end of November, we crossed where we were last year. So what does that mean for the whole year? Well, broadly, I would expect us to get to the year at a similar point where we started the entrance of the prior year. So net average vehicles on hire probably about the same as what we were last year. But importantly, we'll be on that upward trajectory as we go into the following fiscal year. And then in Spain, Spain's really representing the fact there on the lines, which are all going upwards. We've had really good supply for the last 2 years. So last year, we were able to grow average VOH and point-to-point vehicles on hire. And this year, again, demand is really strong. Vehicles, supply is really good. And we're taking that opportunity to continue to grow.
Fantastic. So fleet capex, and I'm just going to ask it in a couple of different ways, or maybe you can answer it. So there's fleet replacement as part of that, and that's probably what we're seeing, and we can talk a bit about aging, maybe. Yeah. And then how it's kind of returning to growth. So when we think about capex, your comments about this year, FY25, I think that's.
Yeah, so it's playing out as we expected is the first thing that I would say. And when we went back to the year end in July, I said that as vehicle supply is improving, I would expect our replacement capex, that's what we spend just to keep the fleet at the constant level, would increase by about a third this year. And that's reflecting the fact that vehicle supply is coming back. We're taking the oldest fleet off, which don't forget is not as operational efficient. It costs us more to service and maintain those, etc. Taking those off and replacing them with new vehicles. As we're doing that, we're reducing the average age of the fleet. So you can see in the presentation, we've got the average age of the fleet in the UK. It's come down by about 4.5 months to just over 31 months now. And in Spain, we're down about just over 2 months to almost 29 months now. So that's coming down as we expected. What I'd also said at the year end is that exactly how much we spend this year will depend on what the demand is and what supply is looking like. And we weren't going to box ourselves in. What we've seen is really strong demand and really good supply now. So I'm expecting we'll spend a little bit more in that second half. So we'll end up with a little bit more than a third for this year. But don't forget, we're managing that within a leverage range of 1 to 2 times.
Yeah. And then just looking out further, I'm kind of doing this sort of capex profile. Yeah. You're just, without necessarily being full numbers, but just in terms of how you see that kind of profile over the next couple of years.
Yeah, look, I mean, I think, yeah, so let's reflect back. It's playing out as we expected, as I said. And look, we're investing in fleet, which is a tangible asset going onto our balance sheet, which has got a good market value as well. That investment in that fleet generates us a good return, and we can see that from the fees we're delivering, which are above our weighted average cost of capital significantly. And it will generate significant flush rates going forward. And what we said is that net cash that we generate just from replacing that fleet will increase year on year. So by the time we get to FY27, we would expect everything else being equal, sort of generating over 200 million of cash flow, which we can then choose how we want to invest. And that's assuming we bring the age down to around about 28 months. We're not aiming for 28 months. We'll just go to what the market requires, and the age is really an output. It's not something we target ourselves.
Fantastic. I'm going to go back to Martin on capex, and then we'll probably get a little bit faster going to it. But capex is good.
Well, CapEx means you're growing or doing something good on the fleet. So, if you look back in this business many years ago before the merger, CapEx in the Northgate business, low margins, low returns, not very much about the weighted cost of average cost of capital. You look at where our returns now, as Philip said, so if you're disciplined in terms of where you're making your investments and where you're getting your returns, of course CapEx is good. And I say about this business, you look at the way that this business is valued, tangible net asset value at the minute, 1.4 billion of assets on the balance sheet through the fleet. So look, two ways to look at it. When you're growing your CapEx, you're growing your fleet, you're growing your earnings, you're growing your cash flows. Okay, so good on a growth cycle. If the economy and the markets are on a down and any sort of downturn, you've got a business here that's very, very strong and defensive, because when you're not growing, your fleet is throwing off excess cash. So I think from two aspects, you've got a sort of a very strong position. But the valuation for this business, in my view, is completely wrong. We've got nearly a billion of revenue coming through on claims and services, which is multi-year contracts with blue chip insurers, body shops and dealerships and so forth, which is a multiple effect. So, so when I look at CapEx, yes, CapEx supports the fleet, and the fleet is core to all the things that we do, but we've got this claims and services, we've got this sort of service revenue that's coming through. So there's fundamentally changed and shifted the shape and outputs characteristics of this business. So I think there's a lot to look through here beyond just the sort of the CapEx and the normal parts of the conversation. But yes, good CapEx means generally good growth.
Okay, and I think that's an important message. So let's move away from kind of the CapEx and the metal onto what we've been doing elsewhere. I think one of your requests from IR is to make sure that the message is simplified and understood for people to really get to that. But you've been simplifying within the business, and there have been the customer first and the One Road programs in terms of streamlining that engagement with customers. Do you want to, because it's been a great success, hasn't it, in the first 6 months of that? Can you?
It is. I mean, we make the point that if you've got a happy customer, everything else sort of follows. And what we do is not complicated. Integrated mobility. So when we break that down, what do we mean? Well, we're providing core services of replacement vehicle, whether that's a courtesy car, a like-for-like replacement car, an insurer-paid car. We're providing repair services through our body shops. So we're fixing people's cars after they've had an accident or an incident. We've got peripheral services like roadside recovery after the accident and fleet management. So these things are all things, in an individual, vertical, easy to explain. What we've done is combine them together. You say, oh, is that complicated? Is that different? Well, no, it's a good outcome for customers. Because if you think you're going through a journey where you have an accident at the side of the road, you've got one company that comes and makes a recovery for you. They take your vehicle to a storage yard, you hand it over to another company as well. We've joined this up and said, you deal with us, you get your service through from start to finish, make it simplified. So for our partners, there's no data leakage, there's no conversion issues, the customer journey is nice and smooth. So that's what we're investing in to make that a very solid story in terms of what we're delivering. And yes, the feedback from the customers is very, very strong based on that. So we're invested in getting those good outcomes, particularly in claims and services. Consumer duty regulations came in, beginning of this year. Insurers very focused on getting that right in terms of getting good outcomes for consumers. We're very much about leaning into that and investing in that position. And if you've got low complaints, excellent ratings on your satisfaction, then everybody's sort of happy in that process, and that's what we aim for.
So you touched in there, we're now moving over to the claims and services side, sort of in terms of headwinds, tailwinds, and actually things that broadly come through, as you said, in terms of that environment. Do you sort of feel that we're now at a place where those headwinds and tailwinds within claims and services broadly through from our expectations?
Yes, I mean, we signalled on our AGM statement, we talk about sort of lowering higher lengths and sort of faster cycle times on repairs. So post-pandemic, there were supply constraints, which parts getting through for body shops across, not just for us, for everybody. It just takes longer to repair vehicles, and obviously you have higher lengths. So, that makes it a slightly elongated process. What we're seeing now as we sort of exit through this period, we're seeing normalisation. Yes, we're going into winter, but typically there is seasonality in claims and services because during the winter, more incidents tend to happen and things take a little bit longer again. But what we would expect to see, so it's correlating to what we would expect historic trends and historic norms in terms of higher length and repair cycle times. There will always be things to do to become efficient and make sure that we sort of stay on top of our game in that. But yes, I would say close to normalisation.
Okay. And then staying on claims and services, if we kind of look out a little bit further into the future, I think sort of the strategic conversations which you have with those insurance partners otherwise about what we can deliver in terms of the technology opportunities for them. Clearly, we put up a slide with quite a lot of elements on that. But how do you see that digitalization, that the tech stack actually serving our customers well?
Well, I think it's important, insurers are spending a lot in providing digital services to their policyholders. And, next generation like to be served digitally. Some people like to have voice. What we say is we have a blend of these things. So think about claims and services. Normally, it's not a, such a stressful sort of position when you've had an accident, particularly if you're at the side of the road with a mangled vehicle or anything else that's going on. You want to be able to speak to somebody. So we provide voice contact. So you can get through to us, you can speak to us, and we can put all the services in place. But equally, we'll make sure that we're efficient. So where we're dealing with things that are a little bit more mundane, that just need to be things processed and booked in, we can use our sort of digital stack to be able to self-serve. So we talk about self-service portals, self-reporting, and people can administrate some of those aspects themselves. But the key thing is, as I said, is that we retain our ability to have voice in our contact center to be able to help customers through a very difficult journey. And that's a very attractive proposition because in a day and age where everybody is trying to digitize and use the AI and all the rest of it, and whilst we're doing that for certain aspects, we will have that ability to provide the empathy that you need as well to be able to handle those claims.
And so in an insurance market which is going through its own changes, as we've talked about in terms of consumer duty and other kinds of consolidations, etc., there's actually a lot of opportunity for us to be that trusted partner for that.
Indeed, I mean, we're doing more of the services for our partners. We talk about partners because obviously we invest in long-term relationships. So being able to provide more of the back office facility. So that's a conversation, I guess, for another day in terms of direction and travel in terms of the strategy. It's been able to have that sort of platform that enables you to do the services that support mobility, and the back office functions for some insurers, might come into those conversations about what we can do and how we might be able to, to provide these sort of aggregated volume necessary in scale to provide those services efficiently.
Right. I've been looking at the questions. I've been weaving a few in, but Philip, just one of those. Shall we just quickly address the cyber incident in May? That's a question from Nigel, but obviously one which we're going to address anyway. So, how significant was the impact? We didn't make an announcement at the time. Do you want to just give us a?
Yeah, look, we didn't make an announcement at the time. It's not a significant number in our overall results. There's no need for us to make an announcement. We dealt with the incident very quickly. We worked with our partners to give them insurance that we dealt with effectively. And we also had every step of the way kind of independently verified as well to make sure we're doing the best thing. But yeah, it was resolved very quickly. The trading impact, as I mentioned, was 4.2 million. We did have some exceptional items which went below the line of 2.8. And without that incident, it would have been 4.2 million higher. So it would have been over 86 million half year, but it was one-off in nature.
Okay. So basically, not material, quickly contained, completely dealt with.
Completely dealt with, yeah.
Okay, so just on some of the questions which are coming through, and obviously growth, and that we talked about the CapEx side, we talked a bit about opening up branches. Aspirations on the M&A side in terms of just other geographies, are there still ones which we'd like to think about? What's your ambition level?
Well, we've done 6 acquisitions since 2020 when we merged the business, and those, besides the sort of the body shop business, which was 2,300 people transferring in and 70 plus body shops, the rest of our acquisitions have been more bolt-on in terms of scale capability, Fitch Express, Blakedale with traffic management and so forth. So we've got a pretty comprehensive suite of services. So what I say is that we're always looking for opportunities where we think there can be added value. So if there's an opportunity that adds value to what we do, and you can scale. I think scale is important in the market. If you're a sub 1 billion business, on a PLC market with liquidity and so forth, I think, adding scale definitely gives you some further advantage. So we're always on the lookout. We have a dedicated team. We have a lot of things across our desk. We assess a lot of things. I don't think we've got the currency in terms of I look at our share price. That is not currency. So I want to be very clear. That is not something I would dilute shareholders on, because I say tangible net asset value is wrong. Now that debate, that's for the market to decide. But in terms of how we can use the capital in the business and the leverage, I think we've shown that we're quite cautious. Even at 1.6 times, that is quite cautious. So we're disciplined about how we deploy our capital. So as I say, M&A is going to add value and be very sort of accretive in terms of what we're doing.
There was a question about buybacks. You mentioned that at the start we were just finishing off that, and in terms of the board's perspective as to when they might come back into play, do you have any thoughts on that?
We keep buybacks under review. We always keep buybacks under review because obviously it's a nailed-on sort of return on that sort of use of capital. And being very transparent, a mix of views from shareholders about buybacks. Some of our investors, particularly in the US, talk about buyback not being a good use of capital because you lose the multiple effect when you're not investing in the business. We've got things we can do in the business. When there was capacity constraint in the market for buying vehicles, certainly in the UK, so you couldn't buy vehicles, then we've done a 90 million program. So you could argue at certain points in time, you can put that capital to use when you couldn't sort of grow as a constraint. But we haven't got constraint, so we can put capital to use to grow in our earnings, and therefore that should have a multiple effect. But as I said, the board will keep buybacks under review and just keep assessing sort of what the best capital allocation is.
So Philip, I'm going to turn to you. It's your last results roadshow before you move on to a very interesting opportunity. Before I kind of ask for any reflections, I think actually, can you just remind people about the business model from a financing perspective? Because there have been questions about what does the market not understand. We've talked about the capex, etc. Martin, clearly, capex in certain situations is absolutely what we're doing. The flip side of that is how controlled we are over that leverage, over the financing, how that model works. Could you just, I want to say remind everybody, but just express in your view how that has worked and how you see that working?
Yeah, look, we are a capital-intensive business when we're growing. We invest in fleet and we use debt to fund that fleet. And we use debt to fund that fleet because we can actually get access to debt at very, very low rates of interest. We control it very tightly. Martin and I sign off on every element of capex spend in the UK on a weekly basis and monthly in Spain. We're meeting with them. We can see exactly what's flowing out when, and we manage that very carefully within our leverage. And you can see actually our leverage hasn't moved year-on-year at 1.6 times. And we have very strong balance sheets. So when we are borrowing £1 from our lenders, we're putting £1 on our balance sheet in terms of the net value. So we're not investing just in tech or just in people. It's a physical asset there. And that's why the lenders look at our balance sheet very favorably. It's a very strong balance sheet, only 1.6 times leverage. Very important. And we've been able to, we have good relationships with all of our lenders. We've just taken out another tranche of private placement loan notes with our existing lenders. So we've taken out another 190 million euros at an average borrowing rate of 4.4%. Now that's much cheaper than what we can borrow from the banks at on a revolving credit facility. So we've replaced some of that revolving credit facility with those loan notes, which brings down the average cost of interest to 3.2%, which is low. So that gives us an advantage in the way we're able to price our product as well and making sure we're delivering the return.
And 83% of our borrowings are fixed over long 10 years, over a long term.
Yeah, up to 10 years. Yeah.
So in many ways, the banks absolutely get it, and they look at us and they really like what they see in terms of the asset-backed side, but actually the growth in cash flows which we can offer them.
Yeah, and to be clear, it's not securitized in any way. They just see the strength of the balance sheet as it sits today. Yes.
Fantastic. So look, I think I've actually run through a lot of the questions. I will be just checking through again now, but you had a bit of a conversation at the time when, which is in our analyst presentation, just about looking back on your time really from the merger and what's really been achieved over that time frame. Do you want to kind of?
Yeah,
Reiterate?
happy to. I mean, yeah, the first thing I'll say is that we are completely different companies. Well, we're one company now, and we were two very different companies when we joined. We run the organisation in a very different way, a different structure to that which we were at the merger. Martin mentioned how much we've changed in the UK. We now have one management team for the whole of the UK and I business. We run it in a much more operational, efficient way, and a much more disciplined way in how we invest our capital and measure returns against that and manage our leverage. Yeah, and I was flicking back at our results since the merger, and if you look back to that first period in 2020 when we reported, since then the net book value of our fleet has gone up by half. As Martin mentioned, our leverage hasn't moved, so 1.6 times, despite that additional investment we made on the fleet. And our profits this year are going to be, if they're in line with consensus and market, be 100 million higher than they were in that period. So whichever lens you look through, we've had a very good set of results year on year up until today. And yeah, the balance sheet we mentioned is in a really strong position to go on and fund future growth. We've got very strong demand, so we should be able to grow very well going forward as well.
Fantastic. So look, before I ask Martin to kind of wrap up, so the questions which have come through have really been about our aspirations, opportunities, our interest in buyback, the insurance market, and what the opportunities are there, touching on our valuation perspectives, margin opportunities. I think we've actually addressed, and I hope everybody on the who've been writing in questions feels that we've addressed as much. If not, feel free to reach out. But I think in order to kind of just sort of bring this to a conclusion, I think, Martin, can I hand over to you to just finish on the outlook, I think, and why you feel so confident in terms of what we can do second half of this year, but also looking further forward.
Yes, thanks, Ross. So look, I mean, I've talked about that sort of momentum as we sort of exit the period in terms of what we're seeing in our growth and our demand and our pipeline. So I'm very confident actually around that sort of delivery and the visibility that we have. As I say, there's a lot more going on in the business now than probably ever before. It really is sort of on the ground in terms of all the programs that we're delivering. There's more to do on the sort of efficiencies, the tech stack and side of things as well. So that will sort of play through. But the products and services that are in demand, we are feeling that sense of growth. We, as I said, at the head, we expected profits on disposals to come down. So there's sort of that expectation of 161 million sort of PBT. That's a sort of the benchmark for a normal year. Feels like that's sort of probably where we're landing in terms of normalization. There's never a straight line in business. There's always be sort of twists and turns. But as I said, if people said in 2020, what could this business deliver? And somebody said 161 million in 5 years' time, PBT, I think that's job well done so far. So we are ambitious. We do want to continue to grow. There's nearly 8,000 people in our business trying to deliver good outcomes, trying to deliver that growth. And we expect that to continue. What we will demonstrate to the market is as we sort of spend in the business, the CapEx that we talked about, what sort of returns, what accretion of returns do we expect that to deliver? And look, at some point in 2027, I say some point, we forecasted that, of course, in our models. This business throws off a wall of cash. So you sort of normalize in terms of where you are with your fleet. It's a lot of cash generation that comes off the back of these investments. And then we've got that sort of look through in terms of that capital allocation, how we want to sort of invest or reinvest that capital for further growth. So very confident on the outlook, very confident on what we're seeing. And as I said, a lot of good things going on in the business.
Thank you. And that to me feels like a very good way to wrap up. So thank you, Philip. Thank you, Martin. Jake, can I hand back to you for the final IMC wrap up, please?
Absolutely. Ross, Martin, Philip, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ZIGUP PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.